Hey, it's Mike at Cross Country Mortgage. Time for your Monday morning mortgage update for the week of September the 30th. Whew, September is almost over. October's around the corner. Fall is definitely in the air, although we're going through a little bit of a heat spell, but it sure is nice and cool in the morning and the evenings. So I always try to give you tools, tips, tactics, things that are happening in the market, talk about what happened last week, talk about what's going to happen this week. So let's talk about last week. Man, we had a lot of nothing, butt kiss, no change. Rates did not change. And this is the third week in a row we haven't seen rates change. And everybody's asking, how is that possible? The Fed cut rates. We see some things in the economy that shows weakness. Inflation seems to be getting under control. Why aren't rates changing? Why do the rates actually go up? Mortgage rates actually go up when the Fed cut rate. And I'm going to explain why this is happening. And so we get a lot of conflicting news. When we see strength in the economy, data that supports a stronger economy, or higher inflation, rates go up. When we see weakness in the economy or data that supports a weakening economy, then rates go down. And we just had conflicting information last week, and it's what we've been seeing for a long time. So two things I want to talk about that's going to affect rates: the Fed and rates, why this is happening, and jobs. Big jobs week this week. And there's something happening probably tonight that can have a major impact on the jobs numbers and labor and inflation and imports and everything else. So let's first talk about Fed and rates. So why don't rates change when the Fed cut rates? How does that Fed rate cut impact mortgage rates? Does it impact mortgage rates? Does it impact the cost of the rate? We know that the interest rate is one part of a mortgage rate, but how much is the borrower or the buyer paying for that rate? That's really important. And so we have been talking about really three things that have the biggest impact on mortgage rates currently, and that's inflation. As inflation goes up, mortgage rates go up. We talk about the strength and the weakness of the economy. A stronger economy means mortgage rates typically go up. A weaker economy means mortgage rates typically go down. And we talk about the Federal Reserve, what they say and what they do. It doesn't have a direct impact on mortgage rates. If you think about, the Fed can't push a button and make mortgage rates go up and down. But what they say and do, in fact, impacts our economy because they set policy, and that absolutely has an indirect impact on mortgage rates. So the federal fund rate, when the Fed decides to cut, raise, or do nothing to that Fed fund rate, like they did this month, a few weeks ago, that impacts short-term rates, credit card rates, auto loan rates, home equity line rates, the rates that businesses are charged when they borrow money from a bank to run their business. But it doesn't direct mortgage rates, or it doesn't impact mortgage rates directly. So the mortgage rates are determined by mortgage trading of mortgage-backed securities in the bond market. I want to show you really a perspective on what's been happening. I show you this all the time. This is that trading of mortgage-backed securities in the bond market. This shows you a one-year graph, and I want you to see back in October, rates were over 8%, and if we look at where they are now, which we know we're quoting rates under 7, we can see a gradual increase in the trading of money in that. When we see this graph go up, that means money's going into the bond market and mortgage rates are coming down. But you can also see the ups and downs along the way here. I kind of explain it to skiing down a ski hill. Yes, we're going down. Yes, rates are going down. And we can see this since October. Almost a year now, rates have been slowly improving, but we're hitting moguls along the way. It's not just a downhill race. It's moguls along the way. And it's not the expert double diamond run. It's probably a bunny hill. It's a gradual downturn in mortgage rates. Definitely trending better. So as we know, mortgage rates are traded in the bond market. And money flows into the bond market and out of the bond market every single day. Our retirement plans are invested in there, our STIRs, our PERS, everything's in that bond market. And as money flows in, mortgage rates get better. As money flows out, mortgage rates get worse. And it goes in every single day. So the daily rates and the cost of that rate is determined by this money flowing in and out. And the Federal Reserve definitely can impact that money flowing in and out because bond traders pay attention to what the Fed does. And the Federal Reserve determines what they're going to do with their Fed fund rate based on data. That's it. It's not a whim, it's data. And the data that we typically talk about is always a few months behind, right? And so the data today maybe a month or two ago, because the data typically isn't real time. So at the end of the summer this year, everybody, economists, bond traders, everybody really expected and understood and believed that the Fed was going to start cutting rates at the end of 2024. And so in July, we had no rate cut. In September, we had a 0.5 point rate cut. In November's Fed meeting, we're probably going to have a 0.25% rate cut. It's not a matter of how much, if they're going to cut rates, it's how much. And December, we may have no rate cut, just depends on the data that's coming out. So when the Fed cut the rates in September, a 0.5%, at the end of the summer, everybody expected that to happen. So they already baked in this cut, this expected cut in the trading. When the lenders come out with rates every day, they already anticipated that cut in September. And they actually anticipated a 0.5% cut throughout the rest of this year, but they didn't cut rates in July. A lot of reasons, because some data hadn't come out yet. And so instead of cutting in July and September, they just cut it all in September. It wasn't more of a rate cut, it was the expected rate cut. They just did it all in 1 month. So now we might see a 0.25% rate cut in November's meeting. Again, they anticipate this. So this is why we don't see these rates fall off a cliff, even though all the clickbait, all the news, everybody says rates are falling off a cliff, all the junk mail that we all get, all the text messages and emails, it's not happening. And so you get this disconnect with our buyers and sellers and what's really happening in the market, where they don't see it. They try to refinance, so they get a rate quote, and the lender says, hey, this is the rate. Say, wait a minute, I thought rates dropped off a cliff. It just doesn't work that way, because this is all anticipated. Bond traders want to know what's happening. They want to know certainty. They have their ducks in a row. They're not fly by night. So all of this is anticipated. All of this is expected. And that's why we're not going to see rates drop off a cliff in another couple months. It's that slow, gradual down slope with a few moguls along the way. So hopefully that gives you some perspective on what's happening with rates. Now let's talk about jobs. Big jobs week, a lot of stuff coming out in jobs. If we start to see strong jobs numbers this week, we're going to see rates go up. If we see weak job numbers this week, we'll see rates go down. But one thing is actually happening tonight. It looks like it's going to happen. The longshoremen, the people that run the docks on the East Coast are probably going to strike tonight. And this is a major, major impact on our economy. They say it could impact $6 billion per day of money flowing in and out of our ports on the East Coast. And this is going to disrupt supplies, and this is inflationary, folks. You remember what happened during COVID? Yes, we had stimulus money, but people couldn't get stuff. I mean, we all remember what happened, and that's inflationary, because fewer supply, prices go up. This could be inflationary, and this could drive mortgage rates up. This is one of those things that you can't predict. It just happens. And we all have to kind of put this in perspective when we start talking about mortgage rates with our clients, and not just give advice based on the unknowns. So think about, pay attention to the jobs reports. We're going to start the week floating, definitely seeing what happens tomorrow and throughout the week with the job numbers and this strike, if cooler heads prevail and they settle this, or if this is going to be a long drawn out strike. So floating into this week, paying a lot of attention every day to the data that's coming out. I hope you have a great, productive week. We'll talk to you soon.